All right, and we're going to do this live one time with a $240 account balance. And here we go. All right, we will be insuring 8740 and 8780 using $244.75 in margin, or full account value, actually. So let us begin. We start by coming to our chart, and we'll bring this back up once we get set up. All right, the next step is going to be to adjust our leverage and find our distance and our PIP value. Distance times PIP value equals contract cost. One contract is normally $75 to $80 is what we cover. So in this case, for every contract that we will be covering, we will need 0.7 lots of euro pound. That is $170.93 in margin with a PIP value of $9.75. So with 10 pips, either way, that will be $97.50 on a payout of $75. That is the formula. And here we are on the euro pound chart, and we'll go ahead and place those orders. 87.80 and 87.40 are our stops and are our strikes. In this case, price is sitting currently at 87.60, which is smack dab in the middle. We'll take two inside positions, and let's get those set up. Inside positions, by the way, are positions that are taking from inside strikes with the take profit and the strike zone being the same. Outside positions are where the entry level and the strike price are the same. Inside, strike price and take profit. Outside, strike price and entry. Real quick on looking at the placement of this order, several things to take into consideration, and no two trades are exactly the same, and the entry levels and the take profit levels and the stop levels all have to be adjusted according to entry time of the trade. In this case, we're looking at a buy stop of 0.7 lots. Entry level is going to be 87.69, and we will be taking profit at 87.81, which is actually the spread is covered in the two extra pips between the price entry level and the take profit. And the way that I determine my stop level is I'm looking at the spread, and I put my stop level 3 times the amount of my spread. In this case, we're looking at 2 pips. So therefore my stop level will be 6 pips beneath my entry. So those are the numbers that we have: 87.69, 87.60, and 87.81 on a buy stop coming in now. Place that order. And we'll do the same thing below. And in this case, we're looking at a sell stop of 0.7 lots. 87.851 is our entry level down to 87.39, and a stop loss of 87.57. And let's go ahead and place that. Now we come and we have our orders placed. We look at our chart. As you can see, we are pretty much set now. We have our stops, we have our entry orders, and we have our take profits in there. Now, does this mean that we can leave these trades to themselves? Yes and no. Depending on the time of day and the volatility of the market that we're looking at, you have got to actively manage these trades. But here is the beauty to this deal. You can actively manage the trade till one of two events happen. A, you actively manage the trade until you reach the take profit of either side. Once the take profit has been reached, the insurance part of the trade is over and the work is done. You simply wait until the expiration of the contract. B, you move your stop level down to an entry level or a small take profit level to where you cannot take a loss on that particular position, and you determine what you will do next, whether the price hits the stop or it's take profit. And C, you encounter a breakout situation, in which that case you would just go ahead and remove the take profit level and continue on behind price with your stop loss, depending on up or down direction that you're going. These situations have to be managed on a per trade basis, and this is one of the reasons why full automation is not a viable means of trading this type of system. But with a hands-on system like this provides a higher level of accuracy and a higher level of profitability for the client as well as for the insurer. So now that we have our trades placed, we have our stops, limits, and our entry orders in place. Now you just sit back, wait it out. This is the basic nutshell formula for setting up a strategic trading insurance trade. Actually, the name of it is multi-platform insurance trading, but this is why we do this, because we're using, as you can see, two platforms. One, a Pax Forex spot Forex account, and the other, a Nadex binary options account, both using the same underlying indicative of the euro pound currency pair. And this is what we do to make a profit. Now, as I said before, we sit back and we see what happens.